Hello, fellow option traders. This is Jeff, and I would like to just talk about the coming correction, and there will be a correction, and how we might take a look at it and might prepare ourselves for it. But if you're looking for me to tell you when the correction is going to be and how big it's going to be so that you can go all in at the right time, this is not the video for you. We're just going to talk possibilities and probabilities and some things you might do to prepare yourself, and some things that I might do to prepare myself as well. Alright, so I thought I would set up a chart that might be a little bit easier to look at than the black ones. I'm not sure if this is easy or not, but you can let me know. I'll show you how I set this up though. All I did was go in here where the monkey wrench is up here, or that little wrench anyway, and I went over here to appearance. And what I did was I picked out for a background, a white background. That was the first thing that I did. And then I said I want to fill my candles, the red and the green candles, and I want a border on them so that you get a little black line around it. Now you can't see the border here right now because everything's really squished down, but as we zoom in, you'll be able to see the border a little bit better. Then the other thing that I did on my account page here is, or that I'm going to do, is I'm going to squish this whole section here. I'm going to squish it over and slide it out of the way so that we can get a total big picture. And don't get too excited about this right now. We will be talking about this. Alright, so let's switch back to the chart. Here is a chart as far back, I think 25 years as Thinkorswim will let me go. I think it's back about as far as we can go. We're looking at 1995. So I went over here to style and I said, well, I want 20 years. So that's as far back as I could go, is 20 years. So it's not 25, it's 20 years, and it's weekly. So that's what we have here. So let me zoom back out again. Okay, so this is the whole 20-year span. You can see that there are some good times with a few little burps along the way, and then some really bad times. This was the crash of 2000 from 9/11, basically. And this is the bank crash from 2007 and 8 and recovering finally in 2009. And just to let you know, this low here disturbs me. The actual number is kind of freaky, and we'll look at that in a little while here. All right, so normally they talk about a 20% correction. So what's an easy way on these charts to take a look at how big of a percent was, say, this move here, or how big of a percent was this move, or maybe from this high to this low? There's a pretty easy way to do that. And the way that you do that is you right-click anywhere in a blank part on the chart, and you go to Chart Scale, and you say Show Price as Percentage. Now, anybody that's seen my videos has seen me do this before. And then the other thing that you can do is you can, okay, let's take a look at this. So can we zoom in here? Is it, I can't, what's an easy way to zoom in? There is no easy way to zoom in. So let's go here to the 2000, which it finally started to recover in March of 2003. So this high here, we'll just right click on this candle, if I can get it on there, and say set this bar as 0%. Now if we look over here, I don't know, I hope you guys can see it. I actually have kind of a hard time seeing it. I would have to change the whole background of everything that I'm doing in order to be able to see that well enough. I wish I could change the colors over here, but I don't think I can. But you can see that right here is the zero line, and here we have positive percent, and here we have negative percent. So we do have a bubble over here on our crosshair. So if we say, what was this correction to here? It was about 28.5%. And we could say, what was it to here is 37%, and what was it down to here? Well, it was like a 47%. So we can say that so far a crash is defined as the market dropping close to 50% or more, because then it starts to recover and it starts moving back up until we get to this high here, which is October 8th of 2007. So let's right click on this candle, set that as 0%. Let's zoom in just a tad more, or try to. I guess it's not going to. I don't know why it wouldn't. Oh, we're frozen here. Just hang on. Sometimes it does this to us. There, now it's going to react. Okay, so our zero, this is the zero line right here, 0%. So if we come down here to this low, this actual low, real low here is like 57%. So from this high to this low in March of 2009 is about 58%, 57%, somewhere around there. So here we have another crash. I don't know what the crash of 29 was, but here's another crash on SPX, the cash index here, of greater than 50%. So now we have kind of an idea of what a crash is, but a correction is a whole other story. They say that those are 20%. All right, so here's a little correction here. We're on a weekly, so this was a couple of months here. So let's change this one to 0. And we'll come down here and we'll look, well, that's 16%. That's pretty close to 20%. How about this high here? Change that to 0. And come down here, that's 20%. That's, well, maybe they're right about that. Do we have any others that look like they may qualify? Let's look at this high here. And look down here, and now that's only 8 or 9%. So we haven't, except for right here in 2011, we haven't really had a correction in 1, 2, 3 plus years. All right, so I want to zoom back out again and just take another look at this. We'll leave it as a percentage for right now. Notice here, this is a double top. I don't know if that really means anything. There might be a head and shoulders in here. There may be a double top here. I don't know about those kinds of patterns, but what I'm looking at is the size and the magnitude of these corrections or crashes. So what was I going to do next? Let me go back here and reset to default 0 level. 0 level, of course, is probably back here. So since in the last 20 years, the market is up 334%. And if we want to change this to the 0 level down here, we could say that since this low here, I must have got the wrong candle here. Let me zoom in. Let's grab this candle, set this as 0. And so we can say that we've had a 200% increase in the market since the last crash. Let's go back to this crash, and we can only go here. Let's see here. Let's go here. I think that this is probably... I don't want to get lost here when I zoom in. So this candle right here is the one we'll pick. And up to there, we're looking at 87% increase in the market. So we're talking quite a difference between crashes and the increase in the market. To say that this current run, which has been going on 1, 2, 3 plus years, is, to say the least, pretty darn remarkable. So like I mentioned about this low here, the low is 666.79. For those of you that attach any sort of significance to the 3 6s, that's not a good number. But I don't know if it means anything or not, because the market sure shrugged it off, and all it did was just climb, and it continues to climb. All right, so when is the next correction coming, or is it going to be a crash? Well, let's look here. Time between crashes. So here we have 1, 2, 3, 4, 5, 6 years of increasing prices, and then a crash that actually, this crash actually took about 2 years to happen. That was the 9/11 crash, we'll call it that. And then this is the Lehman Crash here. So we went 1, 2, 3, 4, 5 years before we had a Lehman moment, and we crashed. And now we're 1, 2, 3, 4, 5 plus years into this current market increase here, or bull run, which is much longer than any of these other ones. All right, I just took a phone call, and I'm not sure exactly where it was that I left off, but looking at where my line is here, it looked like as though I was looking to see how much this move up was, 84%, and this move up roughly was 208%. That's a big move, ladies and gentlemen. That is a very big move. So are we ripe? Well, we might be ripe. And like I mentioned, this run here, and I'm not sure if this is the beginning of it back here or not, but it's 1, 2, 3, 4, 5 years. This run is 1, 2, 3, 4 years. And this run is 1, 2, 3, 4, 5 plus years. That sounds familiar. I think I covered that before. All right. So, what are we talking here? When is it going to happen? I don't know when it's going to happen. But what are you going to do when it does happen? Well, is there something you can do before? So I was kicking around a few things here. If I were to go out to December of 2016, which is 662 days away, and I was to pick the strike of 2400. So what I did was I looked here and I said, okay, so who's most interested in what here on this particular expiration date? And I looked down this column, open interest, and scrolled up and down, and actually outside of some in the money stuff here, the only thing that pops at me is this 2400 price level. Let's go back to the chart. 2400. Let's go back to, not turn off the percentage thing, and let's kind of squish this down a little bit. So 2400 is up here. Let's put a line in there. 2400 right there. Okay, so it happens to be a white line because that's my default. So I'm going to make it a black line. And we'll make sure that it's at 2399.2. No, let's make sure it's right at 2400. And let's run it out into infinity here. A couple of years. That's good. All right, so here's our line up here, this 2400 level. Can it reach there? Well, I need to add a little bit of padding here. So we're going to add some padding on the time axis, and let's go to 50 time periods here. Maybe we're going to need to go to 100. So time axis, let's go to 100 weeks out. Let's go to 500 weeks, since this is a weekly chart. There we go. Now, let's put a trend line in here. And here's going to be our trend. Oops, I don't know what happened there. What happened? Something went wacko here. Come on. Let's go back to auto. There we go. Alright, so we're going to draw a trend line in here. And there it is. And we are going to make sure that it has the right extension is turned on. Okay, so now we can squish this down again. So here we're saying here in actually July of next year, if everything keeps going the way that it is, we're going to hit that short at 2400. And we're going to start worrying then. But we actually have until December, which is like right here. So is it going to pull back and then come back up again? I don't know. But I think that that's a pretty good probability for a trade, I would think. So then what happens when we get not only a correction but maybe a crash? What if the dollar can't hold itself up? What if the Fed can't continue to buy treasuries and monetize the debt like they said they would never do before that they're doing now? What if, say, the dollar's not the currency that they decide to trade for oil, and they just start trading for maybe the yuan or a rupee or whatever? I don't know. Maybe they want to use bitcoins. Do you think that that's going to be a good thing for the market? I don't know. What if there's a big terrorist attack in the U.S. or someplace else? What if Greece defaults? I mean, there's so many things that could happen here to interrupt this trend here that's going to maybe bend it and bring it down to a different date. Actually, we could end this line here on December of, let's go back to December of 2016. And this is the actual expiration date here. So there it's going to actually expire here. That could be a pretty good trade. And if we have a correction, let's take a look at what will happen if we have a correction. Say we get that 20% correction. Let's go to the risk profile. Here's the risk profile. We get a 20% correction. What is a 20% correction from today's high? Well, that brings us actually down to 1688. Now I'm going to grab this line here and move it down to 1688. And without doing a thing, this is where we sit. We will actually be at a $531 profit. We will be about 80% of the $670 credit that we collected. Even if it doesn't do anything over a period of time, let's add some time to this. Let's go out to May or June of this year, June expiration. And, well, we haven't really made a whole heck of a lot of money here, have we? I think we're going to need to go a little bit further. Let's go to December of this year. Expiration. So now our expiration's a year away. We're starting to climb up a little bit. If the market moves up, we're going to be in the hole here. So this price line here is at the break-even point. So if we get up to our short strike, we'll be down $623. But we need to hold fast on this because you're betting on the future. And that's what it is a bet. So you have $1,800 at risk to make $670. That's not too bad of a deal. Let's move out a little bit further. Let's go into, say, like March of next year. Look at this line here. This is March of next year. Now you're up 216 if price doesn't move at all. If we get the correction then in March, you're at 100% profit, barring any change in IV. So implied volatility is going to matter here, because we know what it does to this white line. It presses it down, which makes us wait longer for our profit. But if it's being pressed down, that means price is going down, and that means that we're right. So I don't see very much problem with making a $1,830 bet to make $670. From a probability perspective, that's a 3-to-1 risk reward. That's pretty decent. We just have to wait a really long time for it to do something. And it's going to tie up $1,800 in capital in your account, because your buying power is going to be reduced by that amount. Can you do the same thing with SPY? Sure, you could do the same thing. But the reason why I trade the cash indexes is, again, because they are very high priced, and I don't have to buy so many lots in order to get a decent profit. And then that makes my profit to cost, or my commissions, much more favorable to me. If I only have 2 contracts here and it costs me $1.25 to make 600, that's much better than if I trade at SPY. 2 contracts cost me $1.25 each to make 67. So that's about where you would be with SPY. SPY is about 1/100th of SPX, roughly. So to keep that in mind. So, yeah, this is what I'm thinking right now in preparation for the crash, and then, or the correction. And when the correction happens, then I really start piling in. But one of the other things that I was thinking, back to the chart, if we do continue along this trend line, then I'll just buy up again. I'll sell another bear call up here at, say, 2,600, or maybe 2,500, or maybe 2,700, and maybe push it out even further, because it's got to happen sooner or later. And my bet is that within the next year, probably this year, we'll see a correction, a real one, not any of these little blips here, but a real honest 20% or more correction. So with that in mind, if you're thinking the same thing, you might want to consider doing this type of trade. I'm not telling you to do it, and I'm not guaranteeing you a profit. I'm just saying you might want to consider something like that. So that's it for this video. Thank you very much for watching. Have a great day and happy trading.